Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 31st of March and the end of the first quarter of the year. And a pretty interesting quarter it's been, with a very strong rebound after an absolute smashing in December in particular. So, look, this is going to be a fairly short video because not much has changed in the last week. And looking forward over the next month, until the US earnings season starts again, there's probably not a lot that's going to change. So it was a relatively calm week, and I really don't see much on the immediate horizon. The China-US talks, I guess, can always blow up, but both sides appear now to be intent on getting a solution. So that would appear to be likely to continue to fade. Europe, of course, is a real issue, and there could be more poor economic data out of Europe. But China is stimulating, and the China stock market has rebounded really nicely. So until we roll into earnings season, it really is, I think we're going to see more of the same for the next few weeks. Portfolio Analyst last week was really, it's just a matter of lining up the potentials. As I've been indicating, we're probably going to get bursts of volatility throughout the year, so therefore you really want to be very clear about what stocks you want, roughly what area you want to buy them, or under what circumstances you want to buy them, and just let the market come to you. So that's really what Portfolio Analyst is about at the moment, and there were lots of really good members' questions last week, which allowed me to do quite a lot of really quite detailed analysis. So American stocks for the week, the index was up 34 points. So we had some reasonably strong selling the week before, but the market is very, very quickly steadied. So that was really just on that German manufacturing data and the yield curve inverting. That really got people a bit upset, but the market has certainly steadied very quickly, and of course helped by some renewed optimism around China. The US dollar was up during the week. The 10-year Treasury continues to dribble down. We're now down to 2.41 from a high of 3.3, just probably no more than 6 months ago. And there's really little sign of stress in the credit markets. The bond yield curves have inverted, or some of them have. Some of the less closely watched and benchmarked ratios, which sort of indicates that we could be heading towards a recession sometime in the next couple of years. But then that's not always a perfect relationship either. So don't fall into the trap of assuming that just because some bond yield curves have inverted that we're heading towards a recession. But certainly that's the case. Looks the case in Europe, which looks extremely shaky. But in the US, which is the main credit market, there's little sign of stress at the moment. So let's jump in and take a look at the S&P. So you can see this is the last couple of weeks. We've really just gone up and down. We had 3 levels of resistance. One here at 28.14. Another one, which was the January 2018 highs at 28.72. So I'll just pan back, and so that's these highs here when we had that real blow off top in January last year. And then, of course, the ultimate highs right up here. So all we've done is we've broken the first resistance. We haven't quite made it to the second, and we're just trading around that zone. And I think it's quite possible that we might just continue to trade around this zone for the month of April until we get into the next earnings season. If we look at the Nasdaq, it's looking very much the same. It's very similarly positioned, about the same amount, 3 or 4% off its all-time highs. And if we look at the Russell 2000, it's certainly lower than its all-time highs, but has certainly steadied over the last few weeks. So just checking in on the US dollar. So we're back up almost to we're back up at 97.21. So the recent highs were 97.5. So we're getting back pretty close to that. And a break above this level here, say 97.75, would certainly get things moving back over the 100 mark again. So just while I'm here, let's look at the Australian dollar. So we're still in this sideways consolidation, but you can see it's a downward sloping wedge. And the way things are going in the Australian economy, you would have to think that the RBA is going to have to cut rates, and that should get the Australian dollar back into downtrend again, breaking out of this downsloping channel. So speaking of the Australian market, we were down just a little bit on the week, mainly because we had that strong sell-off on Monday. Managed to recover most of it, but not quite. So the ASX 200 has rebounded reasonably, but look, as I've been saying, most of the stocks in the top 100 and to a degree the top 200 are heavily tied to the health of the Australian economy, which really doesn't look good. So I think you're going to struggle to get more than a single-digit return out of the majority of the Australian top 100 stocks. There are a few exceptions, but not that many. The only other way to get a better return out of the top 100 Australian stocks is just to be extremely disciplined and active, and buy into the sell-offs and take some profit on the rebounds. I think that's the only way you're going to be able to extract a better return from the Australian majors. But on the other hand, there is some fantastic opportunities at the smaller and mid-cap end of the market, and there's plenty of stocks there that I believe have well and truly got the potential to go up by 50% or more in the next 12 months. So I remain very bullish on the opportunities in the Australian market. So we finished just a tick under 71 cents, and we were down by 15 on the ASX 200. Now, I do note that the China stock index, the Shanghai index, had a really good week, finished well on Friday, and the Shanghai index is up 20% in the quarter this year. Now, of course, part of that is the rebound from the selling of December, but we've got some progress on the China-US trade talks, and we've got the Chinese central bank stimulating as well. So some positive things happening there. Precious metals, gold was down sharply as sort of fears seeped away a little bit, down $21, took it back down under 1,300. So just when you thought gold was getting some momentum, the short sellers came back and gave the market a bit of a kicking. But look, I think that's just all short-term price action. It's fairly typical give back when you've had a good period in gold and it's starting to show some strength, then you do tend to get the short sellers emerge. Precious metal stocks, GDX was slightly lower, but look, not much movement really, and it's the Australian gold stocks that absolutely remain the outperformers globally. Turning to other commodities, copper edged up, I think it was 0.01 of a dollar, 1 cent. Crude oil, though, did break through $60, and it really is showing surprising strength given what's going on in Europe in particular. So, yes, quite surprising. There's the copper chart, and of course the inventory levels haven't done a great deal. We've really been around this same area between 180,000 tonnes and 120,000 tonnes for about the last 6 or 7 months now. There's the 3-month crude oil chart, so just a little breakthrough, $60, and you can see that quite clearly on that time frame that the trend in crude oil is definitely upwards. So just to wrap it up, it really remains a waiting game. I think we are going to get little bursts of volatility from time to time, and I think the important thing here is certainly your strategy. You need to determine what it is that you want to own in terms of stocks. Determine a broad buying zone. Now, it's not just a matter of the price getting to a certain level. It's how it does it as well. If it does it with, takes a fair while and really short range candles and not much volume, then you can perhaps enter a stock a bit higher. But if you get some significant selling happens, then you probably want to set your buy zone a little bit lower. But at least have a broad idea of where your buy zone is, and have an idea of your trading tactics. And what I mean by that is, are you going to be buying in several portions? If so, how are you going to stage it? And then, of course, how will you take profit if you're in a trading range? All those sorts of things you need to really sort out in advance. If you try and play it by ear as the market unfolds, it's extremely difficult to make consistent progress on that basis, because you just become hostage to your emotions. And finally, let the price come to you. Don't chase anything in this market. Let the price come back, and I think you'll get a much better outcome that way. Portfolio Analyst this week, it's just really more of the same. There's already some really good members' questions have been lodged, so there'll be plenty of stock analysis, particularly around Australian stocks. And I'll be injecting a few other thoughts as well in terms of other potentials. So that's it for this week. Fairly short and sharp, but nothing much had changed. There's the contact details for any non-members. And remember, there's the $1 2-week trial for Portfolio Analyst for anyone that wants to get a bit more insight into how I go about analysing stocks, both fundamentally and technically. So that's it for this week. Cheers.